One thing you can count on this year in real estate: volatility. In mid-June, mortgage interest rates went over 6%, the highest that they've been in quite some time. So let's talk about why that happened and what's likely to happen the rest of the year. I'm Rebecca, the Mortgage Mentor. I'm here to make mortgages make sense and help you make smart home buying decisions. So be sure to comment with any questions you have and subscribe. The first thing you'll want to understand is what interest rates are based off of. So interest rates are based off of mortgage-backed securities or bonds, and those are bought and sold daily. Based off of the price of that bond or that coupon, then that helps to set interest rates. However, mortgage interest rates are not set by the Federal Reserve. The Federal Reserve's job is to monitor ongoing economic changes and set fiscal policy. One of the ways that they do that is by changing the Fed funds rate, which is the rate at which banks lend to each other. So now that we understand mortgage rates and the Federal Reserve, let's talk about how we got here. So in 2019, the economy was doing pretty well. And the Fed could have raised the federal interest rate from 0, which is where it had been for a long time. But they decided to keep things where they were, likely because of political pressure and because nobody really likes to stop the fun. The economy was doing great, everyone was loving their 401ks, and who would want to stop that? Then we hit COVID in 2020. And because really the Fed didn't have anywhere to go, in the sense that previously if rates had been higher or if the Fed funds rate had been higher, they could lower that to help stimulate the economy. That lever wasn't available, so what did we do? Basically, they shift to the priority of keeping the economy strong, started essentially printing money to put into different programs, and bought a ton of mortgage-backed securities. That's why rates went through the floor on mortgage rates, because the Fed began buying so many bonds, so many mortgage-backed securities that dropped the price, and people were able to refinance or buy at historically low rates. However, this continued through 2021, even as the economy was recovering. Think of it sort of like if you got your car stuck in mud. You are just hitting the gas and you're just trying to go as fast as possible to get yourself unstuck. And when it finally releases, you jump out, tires squealing, and it's really hard to stop because you're coming out with so much force. That's part of what we're seeing now, in conjunction with supply chain issues and corporate profit taking. We are having a ton of inflationary pressures on our economy. Now, again, because mortgage rates are based off of bonds and bonds generate interest, those bonds are worth less as inflation heats up. As a result, interest rates have shot up to try to outpace those inflationary pressures. What happened most recently in June is that the Consumer Price Index came out, and everybody was hoping, and some were predicting, that it would show that inflation had peaked. Unfortunately, it showed that inflation was continuing, and what that meant is that the market freaked out. So rates shot up over 6% in a very short period. Then on June 15th, the Fed comes out and raises the Fed funds rate by 0.75%. This is the biggest single day increase at a Fed meeting in almost 28 years. Why that's so important is it showed that the Fed was finally willing to be very serious and very aggressive to tame inflation. And surprisingly, interest rates come down. The reason that they came down is because there would maybe be some light at the end of the tunnel for the inflation that we're experiencing. So what's ahead? Investors are going to be closely monitoring inflation and the Fed's response to see if the Fed is willing to be aggressive enough for long enough to bring inflation under control. The reason we need to pay attention is because although we could see the Fed potentially raise rates by, say, 0.5%, which would be very impactful to our economy because it does impact things like credit cards, car loans, and other borrowing costs, that could be received favorably as long as it shows that they are continuing to be very aggressive and on it. If perhaps the market is anticipating a 0.5% increase, but the Fed only increases by 0.25%, or perhaps their commentary that is also released is a little bit weaker, then that can cause additional volatility and rates to go up because it's showing that inflation either is not going to be controlled or it could return too easily. My cautionary tale is don't try to time the market, because even with all of this rate flux, rates are still affordable for enough buyers to support the lack of inventory that we have. In other words, that means that demand is holding steady. And because that demand is holding steady based off of the limited inventory that we have, that's why we do expect home prices in most markets and at most price points to stay even, if not even increase more. So you can't go back in time and buy last year's home prices or 2 years ago. You can fix a high interest rate. If you buy now at a rate that's higher than you want, you can likely fix that in the future with a refinance. But again, like I said, you can't go back and buy a lower priced home because it was a previous market's price. Again, I'm Rebecca, the Mortgage Mentor. I'd love to answer any questions that you have. Be sure to subscribe, and I'll see you soon.